Okay, a very good evening, everyone. Thank you for taking time to join us on our Corporate Connect webinar today. My name is Sunny. I'm from SIAS, and I'll be your host for today's Corporate Connect webinar. So this evening, we welcome SGX main board listed Innotek Limited, as well as our audience from the Mumu Live platform. This webinar is organized by SIAS and proudly supported by SGX Group. We will kick off today's webinar with the market highlight segment by Amelia Tan, Director of Research and FinLead at SGX, followed by a corporate presentation by Innotek Limited with their latest business updates. And thereafter, we will dive into the Q&A segment to answer any investment questions that you may have for the management today. So listed on SGX since January 1998, Innotek Limited is a precision metal components manufacturer serving the GPU servers, TV display, office automation, and automotive industries, with 5 manufacturing facilities in China, 1 facility in Rayong in Thailand, and 2 facilities in Vietnam. The group wholly owned subsidiary Mansfield Manufacturing Company Limited provides precision metal stamping, commercial tool and die fabrications, and precision machining works to a strong and diverse base of international customers. But before we dive deeper into Innotek Limited, let me first welcome Ms. Amelia to update us with the latest market movement and highlights. Ms. Amelia, over to you.
Hi, everyone. Thanks for having me tonight. Let me just put up my screen. Okay. All right, standard disclaimer slide. This one is mostly informational, educational, not meant to be advisory, investment advice. Some of the historical returns may not mean that future returns will also be the same as well. So just take note of. And then diving deep into the Singapore market. So March has just started, right? We just finished January and also February. In the first 2 months of this year, we saw STI up about 3% on the year to date in the first 2 months, including dividends. What's notable is that in Feb, especially in early Feb, STI continues to hit a record high of over 3,920 levels in early February. And in fact, last week, we also saw the STI briefly touch a new high of 3,950. And this is after STI recorded close to 24% in terms of total returns for the entire 2024 year. And in fact, when we look at the STI's returns over the last 5 years since end of 2019 up to end of 2024, STI has returned almost 46% in terms of a total return standpoint. So investor activity in the Singapore market, we noted, has been picking up over here. In fact, in the last 10 months, since April last year up till now, STI saw net institutional inflows of almost half a billion going into STI stocks. In terms of passive investing front, the STI, we've got 2 ETFs that track the STI index. The 2 ETFs have also seen their AUM grow to over $2.6 billion. So this year-to-date STI's 3% total returns has also outperformed the regional markets, with the APAC and as well as the ASEAN indices both down about 1% to about down 1%, as well as down 6%. From a sector performance standpoint, some of the top 3 performing sectors of this year include communication services, that is our telcos, utilities sector, and also the 3 banks as a sector continue to perform going into this year. In terms of a breakdown as to which are the top 3 performing stocks in the market so far this year in the index, that would be ST Engineering is up 60% over the first 2 months of this year. And in fact, today, those following this stock, today ST Engineering touched $6 to end at $6.03, which is up a further 2.7% today after yesterday's 8.5% close last evening. And this is also after the strong earnings performance that the market has also seen. Singtel, the second best performing stock, returned about 10% on a total return standpoint. And the third best performing is also SCI, Sembcorp Industries, also around 10% total returns. Now, despite STI recording fresh highs this year and the strong returns that we're seeing, analyst consensus, the 12-month target price that we have from Bloomberg is at about 4,339 points, and this is an upside of about 11% over the next 12 months. Next, since we talked about 2 of the top 3 performing SCI stocks, these are actually stocks that are undergoing strategic transformations. And aside from these two, there are also a total of 6 stocks within the STI that are pursuing or executing the longer term strategic transformations, and includes companies such as Citrium, Singtel, Sembcorp Industries, CapitaLand Investment, Keppel, and also Hong Kong Land. Now, strategic pivots usually, why would companies undergo a strategic review or pivots? These can help companies to build resilient and also adaptable business models to weather economic fluctuations. And for example, some of these strategic reviews also can include things like diversifying the product lines, entering new growth markets to seek growth and expansion, and also maybe even investing into new technology as well as innovation. For example, Citrium, after its combination in 2023, they embarked on a comprehensive strategic review to unlock synergies and build a roadmap for sustainable growth and resilient portfolios. And in fact, earlier last month, they reported that their FY24 net profit is at 200 million and reversing from a net loss in 2023. And they also proposed a dividend of about 1.5 cents per share. Singtel, we might have also heard about its ST28 plan to boost customer experience and deliver value for shareholders. One key outcome for Singtel coming out of this strategic reset is the major restructuring of its business to focus on the 3 areas of connectivity, digital services, and digital infrastructure. Then there is SCI, Sembcorp Industries, where we've heard, over the past year, they've committed to transform their portfolio, continuing to transform their portfolio from brown to green, and also to continue to drive energy transition. CapitaLand Investment, also familiar, right? They are transforming themselves into a global real estate investment management firm by shifting into an asset-light model. Keppel's Vision 2030 is what we've always heard about. It's a strategic plan to transform into an integrated business, providing the end-to-end solutions for sustainable urbanization. And for Keppel, I think the asset monetization has also totaled close to about 7 billion since they started this program in October 2020. Lastly, Hong Kong Land, a slightly more recent one. Last October, they announced its strategy to focus on ultra-premium integrated commercial properties in Hong Kong, Shanghai, and also Singapore by 2035. Aside from STI stocks, actually non-STI stocks outside of the index, and in fact within the mid to small cap space, have seen fair amount of investor activity and also interest. Now, just to share a little bit, the Singapore stock market, within the mid to small cap segment, we have about 150 companies. That would be market cap ranging from about 100 million onwards up to about 1 billion and under. So excluding S-REITs, this group has averaged daily trading turnover of about 40 million over the first 2 months of this year. And tech stocks, as you can see in the 2 tables, they continue to form the majority of this group at about a third or about 35%. In terms of the total turnover, followed by industrial sector as well as energy sector. So follow me, there are 2 tables over here. For the first table, this is the 10 most traded stocks within this mid to small cap group. Again, we see technology as a common sector. Out of the 10 stocks over here, 4 belong to the technology sector. These include AEM, Franken, UMS, and also CSE Global. Now, UMS and CSE Global also ranked among the top 10 mid to small cap stocks with the highest net institutional inflows for the first 2 months of this year. And then we move on to the second table. This is from a performance standpoint, right? It shows the 10 stocks within the mid to small cap group, but according to price performance. So that's the top 10 performing mid to small caps within this group range. PC Partner, the second one over here, is also belonging to the tech sector. They are a manufacturer of computer electronics. They secondary listed in Singapore last year, and they have also achieved the second highest year-to-date price gain. PC Partners recently reported last Friday its FY24 results. Revenue is up 10%. Net profit grew over 270%. And this is a significant increase from what they saw in terms of their results for FY23. Now, we also have another company with us tonight, Innotek, also belonging to the tech sector and within the mid to small cap group range. Innotek's, like what Sunny said, they are a precision metals components manufacturer. What I find interesting, and I'm looking forward to hear a little bit more about them, is that They've also reported latest earnings. FY revenue grew about 16%. Gross profit was up over 10%. EPS up, I think, 25%. And they also marked its 9th consecutive year of profitability and has also proposed a first and final dividend of about 2 cents. So I look forward to hearing from the company's chairman, Neil, and CFO, Angeline, tonight. Now, moving on, lastly, right, what's new from our SGX product shelf? Tomorrow, we will soon have 3 more new SDRs. SDRs are Singapore Depository Receipts with Hong Kong underlying names on Meituan, Xiaomi, and also Ping An Insurance. This will continue to grow our SDR shelf to a total of 8 Hong Kong stocks and 8 Thailand stocks. So these 8 from Hong Kong and 8 from Thailand from each market will cover about over 40% of the respective country benchmarks. And just to recap, SDRs, Singapore Depository Receipts, they allow investors to trade overseas stocks, just like in this case, you can trade Hong Kong underlying names, Thailand underlying names on the Singapore market. So for investors that may be wondering, why trade the Hong Kong SDRs versus investing or directly buying Hong Kong stocks, right? And in this specific case, what will be helpful for local investors is that capital outlays or investment sizes are smaller. For example, you can buy the BYD SDR from $600 as opposed to directly in Hong Kong and at over 30K. Second, it's traded in Sing dollars during Singapore trading hours and also custodized with CDP. Dividends are also paid in Sing dollars, so offering convenience, allowing investors to manage all their positions in a single platform. And so thirdly, from a cost standpoint, because there are no FX charges, it's traded in Sing dollars, lower fees, no custody charges, so more cost effective from the trading standpoint. And lastly, investors can also trade ahead of the Hong Kong market opening, given our current trading hours, and it also overlaps with the US pre-market. All right. And lastly, for those that want to hear more updates on our Singapore market on a daily basis, do follow our Telegram channel. You can scan to follow our channel or sign up for our fortnightly My Gateway newsletter. Thank you, Sunny. Over back to you.
Thanks, Amelia, on the latest market highlights. Great to see that some of the industrial names are also performing very well, apart from the 3 Singapore banks which have been driving the growth for the past few years with the high interest rates. So now we would go to the corporate presentation by Innotek. So I'd like to thank Amelia for the latest market updates. We will now dive into the corporate presentation by Innotek Limited. So let's welcome Mr. Neil Chandara, Chairman of Innotek Limited, and Ms. Angeline Tan, CFO of Innotek Limited. Okay, so Mr. Neil, you may begin your presentation.
Thank you, Sunny, and thank you to SIAS for inviting us to present our company. I'd like to give a brief explanation about the company and our results, which we have recently announced, and take any questions after that. Next slide, please. So we're going to cover a little bit about the company, the corporate background, which Sunny has already mentioned a little bit. Operational highlights about 2024, the financials of 2024, financial highlights and trends, and the outlook for 2025. Next slide, please. So just a brief background on Innotek. We've been listed on the SGX mainboard since 1998. We have a current market cap of a little over 100 million Singapore dollars. Our CEO, Mr. Loh Yil Yang, was appointed in 2016, and under his leadership, Innotek has been consistently profitable and has paid dividends every year since 2016. Today, Innotek is going through a new transformation, extending into new emerging industries, especially AI servers, which are going through rapid expansion at the moment, and the EV, electric vehicles space, which is also growing throughout the world. Secondly, we are expanding our geographical footprint beyond China into Southeast Asia, into the ASEAN region. The company has a strong balance sheet with a good net cash position in order to fund its expansion plan to remain agile in this current rather challenging landscape. Next slide, please. Just a brief explanation about the factories of Innotek and the services that we provide. We have precision metal stamping, tool and die design and fabrication, and precision machining capabilities in our various facilities. We have 5 manufacturing plants in China, 1 in Thailand, and 2 in Vietnam, in the northern part of Vietnam near Hanoi. In China, our plants are clustered around Dongguan, and we also have facilities in Suzhou and Wuhan. Our customers are a strong, diversified group of international customers who depend on us for many of their precision requirements. Next slide, please. So this is some of the products that we are involved with. One of the new areas which is growing very rapidly is the GPU server space. We provide various metal components for the server, including the chassis, and it's an area we see strong prospects in the future. Next slide, please. We have been doing office automation for many years. This is one of the very first sectors that we served when the company was set up, and we do various units for the multi-function copier printers. We do equipment bodies, we do optical unit bases, we do paper feeders. It's a range of different components. Next slide, please. We are also active in the automotive sector. We supply, particularly for some of the EV electric vehicles in the market. We supply the battery pack components. We supply locks and safety mechanisms. We supply electronic units. Next slide, please. Other components, we are very much into safety systems, including components for the airbags. We produce components for the seats, as well as the exhaust systems. This is, of course, for the more traditional petrol cars or diesel cars. Next slide, please. We also produce high-end components for the large screen TVs and display units. These are bezels, which are the frames for the televisions, as well as heat sinks to dissipate the heat from the TVs. Next slide, please. Going to the operational highlights for the company for 2024. The GPU servers, which I've mentioned is our latest business segment, recorded the highest year-on-year growth, lifted by very strong demand for AI servers. There is also higher business for our auto components in international markets, as well as the EV components for the electric cars in China, partially offset by the lower sales of petrol car components, particularly to foreign brands operating in China. Despite a challenging environment, the office automation segment also grew, driven by higher overseas sales, partially offset by a decline in China business. The TV display segment recorded better sales with new product launches from key customers, and we have seen better revenue for this segment from both our operations in China and Vietnam. Early this year, we established Mansfield Surface Treatment Company for treating the metal components that we make. This will enhance our capabilities, improve cost efficiency and quality control, and reduce lead times. We have seen significant growth also in our Southeast Asian businesses. The facilities in Thailand and Vietnam showed revenue growth of 144%, increasing from $12.7 million to $31 million during 2024. So these are some of the highlights of our 2024 results. Next slide, please. Going into a little bit more detail, our revenue from 2023 was at 205 million, has grown in 24 to 238 million, about a 15% plus growth. The sectors which have grown most rapidly is the server sector, as I mentioned earlier, which now constitutes about 15% of our business. The TV display business has remained stable as a percentage of the total business. New field are some of the newer areas that we are now entering. The server was similarly, the AI servers was similarly a new area a couple of years ago, but has grown significantly to justify it becoming a separate area of activity for the company. Auto is our biggest segment, which continues to grow, although as a total proportion of the total revenue, it is reduced, but in absolute terms, it continues to grow, as does OA, which is about a quarter of the company revenue. As I mentioned, the TV display business has been quite stable. The company has strong balance sheet. It has a net cash position of about $65 million. This includes a small investment portfolio that we hold, which can be liquidated quite rapidly. We are planning to declare a dividend of 2 cents a share in 2024. Our NAV is about 76 cents per share as at the end of 2024. The profitability increased from $4.7 million in 2023 to $5.8 million in 2024. Next slide, please. As I've mentioned earlier, we have continued to declare dividends for the last 9 years, since 2016, and there's been a steady growth of dividends from ½ cent to now 2 cents a share, and the dividends have been growing even despite the pandemic. Next slide, please. Some financial highlights about our revenue. As I've mentioned, we have grown 15% to about 238 million. We have higher turnover for the auto segment, particularly because EV, electric vehicles, are gaining adoption, mass adoption in China, and overseas demand has also been improving. New field businesses, these are the new sectors we've entered in the last few years, has ramped up, in particular the GPU servers. The OA sales in Southeast Asia have grown and offset partially by a decline in China. The TV display recorded also higher revenue with new product launches. Next slide, please. Gross profit grew about 10% from 33 million to 36.5 million. The gross margin declined slightly from 16% to 15.3%. And this was largely due to provisions that we have had to make for inventory and tooling obsolescence as we are restructuring our customer base in the automotive sector. This particularly relates to the automotive sector, which is rather volatile at the moment due to the changes in the automotive sector shifting in China from petrol vehicles to EVs. And a lot of the petrol models have a shorter life and are being closed down in view of the changes that are taking place in the market. Our profitability increased by almost 25% to 5.8 million. This is after providing a total of $6 million in one-off exceptional items, which largely relate to special provisions that we have, one-time provisions that we've had to make, particularly for tooling relating to old petrol engine automotive projects, which have reached end of life much earlier than expected with the changes in the China market. Excluding these items, net profit would have been about $11.8 million. Next slide, please. This is a snapshot of our performance since 2020. I think the highlights are that our revenue from a low in 21 of 173 million has been steadily expanding to 238 million last year. And our profitability, which reached a lower point in 2022 of about just over 2 million, has expanded to about 5.8 million last year. Next slide, please. A few words about the outlook. In the automotive sector, we expect volatility to continue, and this is driven by the shift from petrol cars to EV in China. In particular, there is intense competition in the EV market, which I think is creating a lot of volatility in the market, which we expect will result in further consolidation in EV brands. There are almost 100 EV brands in China today, and we expect this will consolidate quickly over the next couple of years. The TV display business remains stable with the new product launches of our customers, and we continue to enhance our capabilities in this sector while maintaining low costs. OA is expected to remain steady with our Southeast Asian operations increasing in turnover, while offset partially by reduction in sales in the China market. We will continue to work very closely with the customers to maintain stable sales in this sector. The star of our business at the moment is the GPU server sector, and we expect strong growth continuing in 2025 with demand from AI and cloud computing. Our key customer in this segment continues to maintain a good position in the market. Next slide, please. So in terms of the outlook, we expect the GPU product range will expand as we are now building new server chassis models. And another very exciting area for us is that we are moving into providing liquid cooling solutions, liquid cooling systems to our customers in order to maintain Innotek's strong position as a supplier in this sector. Innotek has undertaken a strategic review for its auto customer base, realigning our range of products. And as I mentioned, this is the result of the shift from petrol cars to EVs, which has meant that many of our components going into petrol cars models have reached end of life much earlier than expected. The Thai facility in Southeast Asia, these are the newer facilities we have set up over the last few years. The Thai facility has secured fresh office automation equipment orders as well as automotive orders. Besides China, another area where we see potential good growth in automotive is Thailand, from both new and existing customers, which will increase revenue in 25 in Thailand. Vietnam also we expect to be growing in our Asian facilities, Southeast Asian facilities. We are exploring actively M&A opportunities to better expand our geographical footprint to serve customers who are looking for a China plus one strategy. And core to the last decade of our activities, we will continue to focus on quality, cost, delivery, and service to maintain competitive advantage for our customer projects. Next slide, please. Thank you, and I'm happy to take on any questions which may be there.
Hey, thank you, Mr. Neil, for that insightful presentation to help us better understand the business of Innotek. We would now move to the Q&A segment. So please feel free to submit your questions in the Q&A chat box. I already see some questions coming in, and Miss Angeline is also on standby to answer some of the questions that our members or investors may have. Okay. So for our audience on the Moomoo platform, do click on the link to join us in this Zoom, and you can post your questions in the Q&A chat box as well. So we endeavor to answer as many questions as possible. So let's proceed to the Q&A section right now. I will start off with some of the live questions that we are seeing that is coming in. So one of them is by our audience, Mr. Huang, I believe. Given the plans in China, Thailand, and Vietnam, given the current geopolitical situation, which plant would be impacted, I believe, by the Donald Trump tariffs? And what is Innotek's plan to minimize or even maybe need to relocate some of the plants? What are your takes on that, Mr. Neil and Ms. Angeline?
So maybe just a response I can make on this. It's a very important issue that's impacting the business going forward. Our focus in terms of impact is really in China with the Trump tariffs. Some of our customers are actively promoting the China 1+1 strategy, or in some cases even shifting production out of China in order to avoid tariffs, particularly into the US. So our strategy is to reorient our production in China towards those markets that are customers that are not affected. One is, of course, the domestic markets, and this relates particularly to the China automotive market, which is the largest in the world, and particularly the EV sector, which is growing rapidly. And secondly, to focus on customers who can still absorb these additional duties, or more importantly, are supplying products to non-US markets, such as Europe, Japan, and Asia. So we see that Thailand and Vietnam are growing rapidly because of this China 1+1 strategy from our customers. And we expect that China's growth will be more stable compared to Thailand and Vietnam. We are not looking to relocate at the moment from China, but we are looking to expand our facilities in Thailand, Vietnam, and possibly more locations in Southeast Asia.
Okay, thanks for the answer, Mr. Neil. Let's move on to the next question on the Q&A. Since Innotek assembles mainly on component levels, can we assume that it is not much impacted by the US tariff?
You are correct. Our customers are mostly based in China or Southeast Asia, but their products in turn, the end markets, could be the US, and they may be impacted by US tariffs. So to that extent, indirectly, we are impacted. However, we have reviewed closely our portfolio of customers and products, and we feel that the impact on us, of course, will be there, but it will be relatively small because our exposure to the US market, direct exposure to the US market, is relatively very small. Most of our exposure to the US market is indirect, and a large part of what we supply is actually also to non-US markets, such as Southeast Asia, Japan, Europe.
Okay, so I think this Trump tariff situation is a front and center right now. We also have a question on the pre-submitted list that's asking how will the Trump tariffs affect the operations of Innotek, and how will it impact the supply chain of Innotek business as well? So would you like to give some insights on that?
Sure. So I would say that the Trump tariffs, as far as the component level is concerned, the impact is very minimal. But it does impact the supply chain, and therefore our customers could be impacted by the US tariffs. And our strategy, of course, for that, as I mentioned, is to focus more on domestic China and non-US final product markets from the China plants, and to expand our Southeast Asian plants to meet our customer requirements, particularly for the US.
Hey, thanks for that answer. We have a new questions coming in from the Q&A box. From Mr. Caleb, he noted that the net profit is low in terms of absolute and relatively terms. Would maybe the management like to share some light on how is the cash flow status of Innotek Limited?
I think our cash flow remains stable. We are able to pay regular dividends. We are able to fund our growth and expansion. So we have I would say, reasonably stable cash flow. The profitability is relatively been low over the last couple of years. We had higher profitability before that, as we went through this changes that have happened in the markets. In fact, if you take our underlying profitability during last year, it is significantly higher. As I mentioned before, is one-off provisions that we have made for prudent purposes. Our underlying profitability is more in the $11-12 million range last year.
Okay,
Our
thanks.
cash flow status remains quite steady, and as I mentioned, our cash position in the company and the balance sheet remains strong.
Hey, thanks for sharing some of the cash flow status of the firm. Let me shift our attention back to one of the pre-submitted questions. We talked about Donald Trump tariff earlier. So what are some of the other biggest risks that Innotek see right now in the macro environment? And how is the company mitigating some of these risks that you may have identified?
I think the significant risk we see is in the China market on the automotive space. Because there is a big transition taking place, and many of the old, particularly foreign branded petrol car models are reaching end of life much earlier than anticipated. And normally when we enter these projects, it's on a basis of a car model life of 5 to 7 years. And when if these models, they reach end of life 2 to 3 years, because of the changes in the Chinese market, then obviously this has resulted in us having to make provisions, one-time provisions, particularly on our tooling, which we have built for these projects. So we think there is a big change happening in the China domestic market. The second, of course, as we all know, is the Trump tariffs, which means that many of our traditional customers in China who have been exporting to the US are shifting base. Some are shifting base partially, some totally, into Southeast Asia. And we are trying to capture that business through our existing and maybe new operations in Southeast Asia. A third risk, which I think we are, of course, always watchful for is, AI is a very new sector, and of course, going through explosive growth at the moment. But we think the growth is sustainable, but it's something we need to watch very carefully.
Okay, thanks for letting us know some of the key risks that Innotek are facing and how the company can be mitigating them. Indeed, the China automotive industry is changing very quickly with people shifting to EVs, and that it could relate to the one-off 6 million amount that you could be talking about earlier in the presentation just now. Okay, let me move to the next question. So what are Innotek looking at for the key growth drivers for the next 3 to 5 years?
So of course, one of the key growth driver is is the AI segment, and we see this. We expect over the next 3 to 4 years to be actually sustainable, and that's going to be, we think, a strong growth opportunity. The second is the EV sector. At the moment, it's going through a lot of transition and huge competition. I think many auto companies are having to drop prices continuously in the EV sector and the traditional car sector. So it's going to be still a large period of adjustment, which is going to happen in the automotive space. But we think the EV sector is growing very rapidly in China, and will also do so globally. And that we expect to be a major growth driver for the company going forward.
How about, will you be able to give some projections, because we saw your presentation earlier, the server segment, which grew from 10 to 15% contributions to Innotek's performance. How do you have any forecast of how this segment will grow in the next few years? Any
I expect
estimations
it.
there?
I think it's very speculative to say over the next 4 or 5 years, but I think it'll become a very key important sector for us, just as today we have the automotive and the OA sector and the TV display sector. We expect that the AI sector will become as important, if not more important, than some of our existing core sectors. So we see significant growth in this sector going forward. But I would say it's difficult to predict today with a lot of uncertainty, particularly around the economic environment with the Trump tariffs. So we have to watch and see how things develop. As far as the future prospects are concerned, we grew last year 15% in top line, and we would hope to be able to sustain this level of growth in the future. But it's still very uncertain because we don't know what will be the outcome of the tariffs that Trump is planning and already put in place in some cases.
Yes, agree on that. There could be some flip-flop, tit-for-tat action that I think the tariff situation will take a few months to stabilize down so that we will know the clearer picture. And also, I believe the GPU server rack is also in line with the growth of the data centers. Am I correct?
That's right. So, AI requires a huge amount of data processing. And as a result, a large amount of basically AI servers are required. AI server racks are required in each data center.
Yeah, so as a statistician and academia, I think if you like to know the growth, probably the audience might want to see how much is the data center growth projected in the industry, and then how much Innotek will be able to capture those, especially with some of their more innovative products, which include the cooling system that Mr. Neil mentioned earlier. So let me move to one of the latest Q&A questions that came in from Caleb. Innotek is trading near the 52-week low. Okay, and the share price of 41.5 cents, close at 42 cents today. Do you have any thoughts on why is the share price this was down so badly despite markets has been up in the past 1 year or so?
I think two issues. One is, of course, China has been impacted quite severely, particularly, and our larger part of our operations are in China. And China has been, I think, very much impacted by this local domestic economic situation on one side, which has been quite sluggish, and on the other side, of course, by the issues of the Trump tariffs. So I think that's probably one of the areas which has dampened the stock. I would say generally another issue has been that the company is a very small cap company, and has limited interest from investors, and I think it requires more interest from the investment community in order to go back to its earlier values.
Yes, that I agree. I was actually researching on Innotek research reports, so not much of a coverage, but I believe this is the purpose why SGX and SIAS, we are doing this Corporate Connect session to get investors to be more aware of some of the names that we see in this session, like Innotek, that could provide you that could have a position on your portfolio given the stable growth and the stable dividends that the company is giving out. Okay. So moving on to the next questions, Caleb requested for the slides. I think we can ask the IR of Innotek to share with us the link to the latest business update and reports, so that we will actually share that with you. Okay.
Yes, in fact, the presentations will all be available on our website.
Thank you very much. So we will share that their website link with our audience here, should they want to look deeper into the growth and the numbers of Innotek latest business updates. So let me move to the next questions from Mr. Huang. What are the key competitive advantage in the AI server sector that Innotek has? Do you intend to build some kind of a competitive advantage or some kind of moat around this new sector that is likely to be growing rapidly and becoming a big component of revenue for Innotek Limited?
Absolutely. So, our competitive advantage is that we have great deal of technology and technical depth and skill to be able to provide the kind of metal components and chassis and casings required by the new generation AI servers. In fact, our focus and our skills are best appreciated in the top end range. So the 4U servers or the 8U servers, which are the top end of the AI servers. For many of these models for our key customer, we are actually the sole suppliers. So, it involves a certain amount of capability, technical expertise, particularly at the higher end of the servers, which is, where the big demand is. So we certainly have the capability to serve this industry and to continue to build this moat. The next area that we are very much focused on at the moment is the liquid cooling solutions. Most AI servers, because of the huge energy consumption, are moving now from air-cooled servers to liquid-cooled servers. And so we have developed solutions for liquid-cooled servers, which we think will provide us a huge competitive edge and stickiness with the customer, as well as better margins, because we'll be able to provide a very good solution to dramatically reduce energy costs for the final consumer.
Interesting. Yes, I'm also a tech geek over here. I also have a liquid cooled CPU system at home. It's interesting to see that Innotek is developing such product to meet the demands of the data centers and the server cooling system. Would you say who are the other competitors in the markets that have this system as well? Would you be able to share with us your key competitors and what are the advantage that Innotek would have over them?
Sure, I think most of the server companies offer liquid cooling solutions today. They offer servers with liquid cooling solutions, but some of the cost structures are a little high. Some of them are probably efficient, but we think our solution is more efficient and shows better cooling than some of the existing solutions. If you go buy servers today from a Hewlett-Packard or a Dell or a Supermicro or Lenovo, I think you'll find that cooling solutions are available in the market today. But this technology is rapidly improving, and we think we are on that trajectory where we can offer good solutions to our customers.
Interesting. So product innovation will probably help Innotek capture this AI tech sector going further with the data center growth. A very quick question from one of our audience. He's asking, are there any plans to do a share buyback in the near term?
So we may look at this depending, of course, on our performance on one side and our cash requirements. We do at our AGM, we will be proposing at the next AGM to have approval for a share buyback scheme. So that option is available to us, and depending on the requirement of our own business and the liquidity of the company and the profitability of the company, this is certainly an option to consider that we may look at in future.
Okay, so I hope that answered the questions on share buyback. The option is on the table, but we'll go through the AGM and see the needs of the company requirements to see whether if that option can be activated. Okay, so the next question would be, given the headline news of further deteriorating dynamics of the ICE, the traditional combustion engine automotive sector in China, we noted the one-off 6 million exceptional items this year. So do you foresee there will be further exceptional item in FY25?
So we cannot, of course, exclude that possibility. We have done a detailed review of our operations, particularly the automotive side, to see that we have ensured that whatever we think is appropriate on a prudent basis to make those provisions. But the market is changing very fast, so we have to wait and see. Sometimes we are not even sure. We think this car model may be looking quite solid, but suddenly, the final car company, the car brand decides that they don't want to continue, they discontinue the model. So we are obviously very watchful, and we have to be cautious. We think the provisions should be lower than what we have had to do in 2024, but it's still probably a little too early to say. So we can't exclude the possibility of provisions, but hopefully, we have already done a large part of what may be necessary.
Okay, perhaps maybe to dive deeper a little bit on this point, because we sort of noted the 6 million one-off exceptional item. So what constitute or what goes into this? For example, the example that I said earlier, a car model may becomes obsolete or not in production anymore, and hence the components might not be required. So in such kind of scenario, what will happen to some of the equipments and some of the components that you have been doing? What will happen to them that costs this 6 million? Will you take us through some of the details so that we can better understand and help us to foresee what kind of exceptional items might be coming up?
Sure. So, we deal with very large and very well-known tier one companies. We don't deal directly with the automotive companies. We are tier two. So tier one companies would be large international companies like Bosch, Continental, ZF. These are, very big conglomerates which use our components for various automotive systems that they provide to the final customer. What happens is that when a model has reached its end of life prematurely, obviously there is a large tooling which we have invested into, which we now then need to make provisions for. And I think that's the largest part of what the write-off is. Of course, we go and negotiate with the T1 companies and try to find a good solution, but we often have to take part of the hit to our own bottom line. So this is, I think, one of the key issues that we faced last year. As far as inventory is concerned, yes, that is also part of the problem, but that is a smaller amount compared to the tooling, because the tooling is something we have built for 5 to 7 years. The inventory may be a few months of inventory that may be excess. Again, we negotiate and discuss with the suppliers and the final car companies to at least be able to find a solution, but we need to also then absorb part of the cost ourselves. So it is largely tooling related. We've also had some one-time additional property taxes. The way the Chinese government, I think, in their plans to raise further revenues, have increased some of their property taxes, which we've had past taxes that we've had to pay for the property taxes. For example, our additional one-off items. And then there's been some impairment, as you said, some equipment, some areas like that where there's been some impairment because of some projects.
Okay, thanks for indulging us to share with us more insights into how the operation, the business is on this tooling business for the cars and the one of the exception items, which gives me a clearer insight of how the operations and the plans for company works right now. You mentioned earlier, we have talked quite a bit about US tariffs, and you mentioned China earlier, which sort of piqued my interest a little. China growth has sort of not been very rosy recently with the property sector problems. What do you see? What do you see of China growth going forward? And what do you see of Innotek growth with China's economy, whether it could be growing or it could be stagnant in the next 1 or 2 years?
I think, China growth definitely has been sluggish over the last couple of years. And I think the Chinese government is actively trying to revitalize the economy with its own intervention into the economy to increase consumption. But I think it will be difficult, and particularly this will be also, the economy will also get affected by the Trump tariffs, particularly for those export-oriented activities. So I think the China prospects look difficult going forward. But I would say from our perspective, we think we don't see big growth, but we see a good stable operation continuing, largely because one of the key sectors for us is the EV sector. And the EV sector is showing this, in China, you have the traditional sectors like property and infrastructure probably slowing down, but you have areas like EV sector, which are growing still very, very rapidly. Technology is growing rapidly in China. So we think some of these sectors which are growing rapidly will continue to provide us support in China, but we expect growth to be much stronger in Southeast Asia than China for us.
Right, thanks for giving us the insights into China growth and of course Innotek's growth in this segment of the market as well. We have one question from Mr. Huang. How does the ownership of Innotek look like? What are the proportions of shareholders that are institutional, private, or even public? Do we have information on that?
Sure. About half the company shareholding is with the original promoters of the company and also with the CEO, Mr. Loh. So between the two of them, they own about half the company. The other half is widely spread among mostly private individuals. Maybe there may be some small institutional holding also, but it is a widespread holding as far as the balance half is concerned.
Okay, so that will give us the ownership picture of how Innotek's share ownership looks like. Half of it can be held by the CEO and the related partners, and the other half could be private and public holdings. We have coming to the end of today's presentation, this webinar. We have 3 minutes left. I'd like to dedicate the last 3 minutes to some of the more sustainability and ESG topics that have been also of concerns. So are there any ESG or sustainability plan that Innotek has in place to reduce your carbon footprint, to increase energy efficiency or carbon reduction? Will you be able to share any sustainability or ESG plans on that?
Sure, actually, and we publish a sustainability report for this. We've been moving towards using more solar energy. So all our factories today have panels across all our plants in China. We've been using more efficient equipment, which also reduces the consumption of power and water. We have put in, as I mentioned, we set up a new subsidiary for surface treatment, which is much more efficient and brings down the amount of pollution dramatically in some of the surface treatment that we do for the components. So we are actively on this journey, and it continues to be an important part of what we do going forward.
Thanks for that. And on the topic of corporate governance, which has some kind of spotlight in the market recently, I also noted and read the reports that there were 2 independent directors that completed their 9-year term and they have stepped down. Are there any incoming independent directors that have assumed their roles, and what would be the responsibility likes of these new independent directors, and any other corporate governance assurance that you can give to shareholders and investors who are looking at Innotek as well?
Sure. So I would say that we had a wonderful contribution from the 2 independent directors. However, they required to retire because they had completed more than 9 years. We have already inducted a new independent director middle of last year, Mr. Ng Hin Lee. He is actually chairing the Audit and Risk Management Committee for the company. And he is a very seasoned in in audit, finance, accounting, and risk management. So we think he will be a great asset to the company. We will continue to bring in more independent director possibly this year, because we have another independent director who will also be completing more than 9 years this year. In terms of corporate governance, we have only one person who is the CEO on the board. The rest of the team are non-executive, and there are 3 independent directors on the board. And we basically follow all the core and key corporate governance requirements that are required. And I would say that we have a very clean business. And I think that has been a concern in the past for some of the Chinese companies. Although we have many businesses in China, I would think that our management structure and our systems certainly are very transparent and allow a great deal of confidence in the numbers that we balance sheet and financial numbers that we produce.
All right. Thanks, Mr. Neil, for that assurance. I think that will give the investors and people who are looking to invest into Innotek a very good assurance of the company in adhering to the corporate governance standards, and of course, the operations of the company can continue for a sustainable long term. The time has already passed 8 p.m. already. I'd like to thank Mr. Neil and Ms. Angeline for joining us today and indulging us and answering questions from investors and members of the public to better understand Innotek business. So I also like to thank everyone here for joining us tonight this evening. I hope that you find this a Corporate Connect session with Innotek Limited very useful and innovative to help you make your investment decision. In case you do miss any part of today's session, you can actually rewatch this webinar on our SIAS YouTube channel as well. So Corporate Connect is actually our bi-weekly webinar. So do visit our SIAS website to get updates on the latest investors education program that will be coming up. And in the next Corporate Connect, we will be featuring the next listed company, which is PropNext, the property company. So if you'd like to know, like us to invite any companies to be hosted on the Corporate Connect webinar, you can also let us know in the chat box over here. So in the next run, we will see PropNext together with our audience here. And lastly, I'd like to give my thanks again to Mr. Neil and Ms. Angeline for joining us today for more than the past 1 hour. And we'd like to thank everyone today as well. So take care and have a very good evening. Good night.
Thank you so much.
Thank you.
Bye-bye.